Hello, welcome to the online classroom for the module FIN4801, Advanced Financial Management. In this class, I'm going to take you through the first part of a very important study unit in this module, namely study unit 8, known as capital budgeting. So study unit 8 is the first study unit under section C, which relates to investment decisions. And it's just got some outcomes. Always take time to read the outcomes. I think I'll touch on about 2 or 3 of these outcomes today, or maybe 4. I'll talk about 1, 2, 3, 4, 5 up to here. And then in the second class, I'll take you through determining the cash flows associated with the capital project. You should be familiar with most of the things I'm going to talk about in here. There might be a few things which are new to you, but a lot of these things will be revision from FIN4701. So it shouldn't be a very difficult class for you to follow. Even the capital budgeting cash flow section, when we get to the cash flows, the second part of the study unit, there'll be a lot of concepts that you are familiar with from FIN4701, but there are some slight additions. So most of this should be revision. Okay, so you should be familiar with what we mean by capital budgeting or capital projects. Remember, a capital project just involves a large initial outlay. It involves a large initial outlay and then cash inflows coming in to the company after at least 1 year. So when we talk about a capital project, we're talking about a large initial outlay and then cash inflows coming into the company after more than 1 year. If cash inflows come into the company in less than 1 year, then it's not a capital project. So with capital budgeting, we're talking about a large initial outlay and then cash inflows coming into the company after more than 1 year. So when we talk about capital budgeting, we're talking about trying to make decisions, making decisions on which capital projects to invest in. So you're trying to decide which capital projects to invest in, right? So that's what we mean by capital budgeting. We are budgeting and trying to decide which capital projects to invest in. So there are a number of terms you're supposed to be familiar with. You'll be familiar with most of these terms from your undergraduate studies in FIN4701. Firstly, you need to know that there are 2 main reasons why a company can pursue a capital project. You might be asked to identify the reason why a company is pursuing a capital project. The first reason is the replacement of an existing capital project. A company might want to replace an existing capital project, so they might pursue capital budgeting or a capital project to replace an existing one. And the second reason is expansion. A company might want to expand its business operations. So these are the 2 main reasons why a company would pursue capital budgeting. So let's briefly discuss about each of these. A replacement refers to the acquisition of an asset to maintain existing production. The new machine may result in cost savings due to increased efficiencies. The firm is producing an established product line and the cost savings are usually relative certain. So when we're talking about replacement, we're just talking about a company replacing an asset that it currently has with another asset. And this might be to try to boost efficiencies in how the asset operates, or to try to save costs or to minimize expenses associated with producing goods. The other reason why a company would pursue capital budgeting, like we said, is expansion. And expansion refers either to the expansion of existing product lines or to new markets or the introduction of new product lines. So if the investment project refers to the introduction of a new product line, estimated demand may be highly uncertain. So it is therefore difficult to estimate future cash flows. One important thing you should note about capital budgeting or capital budgeting projects is that the risk associated with capital budgeting projects is the uncertainty in estimating the cash inflows from a particular project. So that's a big risk. So with expansion, there's a lot of risk associated with the project because you're trying to expand operations, and that introduces a lot of uncertainty with regards to the demand of the new product line or the new area you're expanding into. But when we look at capital budgeting, the most common reason why companies pursue capital budgeting is for companies to expand their current operations. So expansion is the most important, the most common reason why a company would pursue a capital budgeting project. Okay. Also, you need to be able to distinguish between two types of capital budgeting capital budgeting situations. When you're looking at trying to decide which capital projects to invest in, you might have independent capital projects, and you might also have mutually exclusive capital projects. When we say that capital projects are independent, it means that you are allowed to choose more than one project as long as the projects are profitable. But when we say capital projects are mutually exclusive, it means you can only choose one capital project. The selection of one project means you can't choose another project, okay? So you touched upon this in your earlier studies, so a lot of this is revision, like I said. So I'll repeat. If capital projects are independent, it means that you can only choose one capital project. It means you can only choose one capital project. So if capital projects are independent, it means you can choose more than one as long as the projects are profitable. Whereas if capital projects are mutually exclusive, it means that you can only choose one. Okay, so let's just read this to help us to understand this better. Independent projects are such that the acceptance of one does not affect the acceptance of another. So when we say our capital projects are independent, it means if we accept one, we can still accept another projects. Therefore, if projects A and B are independent, if project B may be accepted or rejected, irrespective of whether project A was accepted or not. For example, a company might analyze two projects, a material cutting machine and a new delivery truck. And the firm may decide to accept both projects if a certain economic criteria is met. So usually that certain economic criteria might be, for example, it might be having a positive NPV, right? So with independent projects, we are allowed to accept more than one project. We accept as many projects as we can, as long as the projects are profitable and as long as the projects are within our budget, okay? Compare that to mutually exclusive projects. So with mutually exclusive projects, either one or the other can be accepted, meaning you can only accept one project. You can't accept both. So let's say you have three projects you're trying to choose from. If we say the projects are mutually exclusive, it means you can only pick one project from those three projects as long as the project is profitable. So for example, if a firm has decided that it needs to invest in delivery vehicles, it may have the option to invest in either one large delivery truck or two smaller trucks. So these are two different capital projects. These are alternatives. The company can decide on the larger truck, then it won't invest in the smaller trucks, or they can decide in the smaller trucks and then they won't invest in the larger trucks. So when we talk about mutually exclusive projects, whether you get an assignment question or an exam question, and you're trying to decide between two projects, if you're told your projects are mutually exclusive, it means you can only choose one project. Whereas if you're told that your projects are independent, you are allowed to choose more than one. as long as the projects are profitable. Lastly, you should also be able to distinguish between what we call divisible projects and indivisible projects. Divisible projects means that a project can be split into a number of parts which are capable of being undertaken on its own. If the project is indivisible, then the entire project must be undertaken. In capital budgeting, financial managers will often face problems with project divisibility. For example, the decision to build a toll bridge may represent an investment in an indivisible project. Okay, let me just illustrate through a simple example what we mean by a divisible project or an indivisible project. Okay, assume that a project has an initial investment of 3 million. Assume that you need to spend 3 million on a particular project. And let's assume that this project can give us a net present value of 300,000, right? And let's say the company only has 1 million to spend. If this project is divisible, if we are told that the project is divisible, right? It means that the company can take a part of this project. It means that the company can spend this 1 million on this project, right? And by spending 1 million, it means they will only get an NPV of 100,000. They spent 1/3 of 3 million by spending 1 million, meaning they will only get 1/3 of the NPV. Okay. So that's what we mean by a divisible project. It means that if we don't have enough money for the initial investment, we can spend part of our money on that initial investment. So in this case, it would be 1 million of our initial investment over a total of 3 million, which gives us 1/3. So we would invest in 1/3 of the project. And as a result, we would also get 1/3 of the NPV. So that's what we mean by divisible projects. But if the project is indivisible, it means that's not possible. It means we need to spend the complete 3 million or nothing at all. I hope you followed that and that makes sense. It's not common to get questions on divisibility of projects in this module, but you need to know it, it might come. So when we talk about a divisible project, it means you can spend a fraction of the initial investment on that project. Right, so I now want to move on to capital budgeting techniques. Again, these are techniques that you will have come across before in your studies. And in this particular module, we are going to, for this study unit, in the next study unit, we might look at other techniques. But in this particular study unit, we're going to focus on 8 key capital budgeting techniques. We're going to look at the net present value, the internal rate of return, the payback, the accounting rate of return, the discounted payback, the profitability index, the economic value added, and the modified internal rate of return. For the purposes of the exam, you need to be comfortable with using each of these techniques. You need to know how to use the NPV, how to use the IRR, how to calculate all of these. You need to know what these capital budgeting techniques mean, and you also need to be able to state the advantages and disadvantages of each of these capital budgeting techniques. So let's move on. So I actually titled it revision because you've done a lot of this before. So I'm going to look at some of these capital budgeting techniques through an example, and then I'll visit the other techniques through just a discussion. So the example reads, a project has the following cash flows. There's an initial investment of 200,000. The cash flows from the project are as follows. You get 150,000 Rand in year 1, 100,000 Rand in year 2, 260,000 Rand in year 3, 180,000 Rand in year 4. We've been told that we're using a discount rate of 12%, and then we're asked to determine the NPV, internal rate of return, profitability index, payback, and the discounted payback. So it's going to be a bit of revision here. So I'll look at each of these techniques using this case study. Remember from your previous studies, the NPV gives the monetary value a project adds to a company as a present value. So the payback tells us how much money a project is adding to the company, and we're given the answer as a present value. So we accept a project if the NPV is positive, and we reject a project if the NPV is negative. And when you're comparing two or more projects, the higher the NPV, the better. Now, the important thing to note when it comes to calculating the NPV is that we're simply taking the sum of all, the sum of the PV, the sum of the present value of all future cash flows. So we're taking sum of PV of all future cash flows minus the initial investment. Yeah. We're taking the sum of the PV of all future cash flows minus the initial investment. And then this gives us the NPV. So if you look at the prescribed textbook, they give a formula like that, but you don't have to worry about that formula. Of course, we use our financial calculator, but this is the formula that they give. The sum of all the sum of the present value of all the future cash inflows minus the initial investment, and then we get the NPV. So we said we accept a project if the NPV is positive, and we reject a project if the NPV is negative. So I'm going to take you through how to do this calculation using an HP financial calculator. I'm going to use an HP financial calculator to show you how to do this question. Let me take you through that now. Okay, so let's go through this calculation. I've put the HP calculator up on the screen. As always, we start by pressing the red shift button and then C to make sure that our calculator is clear. If your calculator is on 12 PYR, which it usually is by default, you need to change it to 1 PYR. So you press 1, then the red shift button, then PYR, and then your calculator will be on 1 PYR, right? And then after that, we can now enter in our cash flows. It's 200,000 as a negative. Then we press the cash flow button, then we get CF0. 150,000, then we press the cash flow button. 100,000, the cash flow button again. 260,000, the cash flow button. 180, the cash flow button. 12%, which is our interest rate. Then we press the red shift button, and then we come to PRC NPV, and we get 313,104.08. So we would accept this project because the NPV is positive. So that's how we use the NPV. And then the next capital budgeting technique is the internal rate of return. And the internal rate of return gives the discount rate that equates the NPV to 0. The internal rate of return gives the discount rate that equates the NPV to 0. So we can look at the internal rate of return as the rate of return on an investment. And we accept a project if the internal rate of return is greater than that discount rate. So the idea behind the internal rate of return is that it can be considered to be a hurdle discount rate. And I can illustrate this to you through a simple example. Okay, so I was saying that we can look at the internal rate of return as a hurdle discount rate, right? We said that is the discount rate that equates the NPV to 0. So we can look at it as a hurdle discount rate. So what exactly do I mean by this? I'll put up the whiteboard just to explain what exactly I mean by that particular explanation. Okay. So what I mean is, let's say, for example, we've been told that our internal rate of return is 10%. Let's say our internal rate of return is 10%, right? Okay, sorry, this board is not coming out the way I want it. Let me just set it up properly so that you can see clearly what I'm trying to illustrate. Right, so this is what I'm trying to illustrate here. As you'll see, let's say our internal rate of return is 10%, right? What that means that at a discount rate of 10%, our NPV will be 0. So we can consider these right here to be discount rates, the ones that I've put here. So if the internal rate of return is 10%, it means that our NPV is 0. So the way the internal rate of return works, it works as a head of discount rate. It tells us that if we use a discount rate which is greater than the internal rate of return, for example, in this case, 11%, 12%, or 13%, our NPV is going to be negative. And if we use a discount rate which is less than the internal rate of return, for example, 9%, 8%, or 7%, our NPV is going to be positive. So the internal rate of return is just a head or discount rate. It tells us the discount rate above which we will get a negative NPV and below which we will get a positive NPV. So when we're trying to decide between which capital projects to invest in, we invest in a capital project if the internal rate of return is greater than the discount rate, and we reject a capital project if the internal rate of return is less than the discount rate. So we can do a calculation just to illustrate how to calculate the internal rate of return. It's very similar to the approach you would use to get the NPV. We press the red shift button and then cancel. Always check to make sure your calculator is on 1 PYR. And then it's 200,000. We put our negative, the cash outflow, 150. And then 100, 260, 180. And then we press the red shift button, then we come to CST IRR, and we get 68.88%. So this is a very high internal rate of return. And because of that, we accept the project because the internal rate of return is greater than our discount rate. Okay. Right, so we can now move on to the next capital budgeting technique. So for the third capital budgeting technique we're going to look at is the profitability index. So the profitability index is also known as the benefit cost ratio. It's also known as the benefit cost ratio. And the benefit cost ratio gives the return for each rand invested in a capital project. So what do we mean by this? If we calculate our profitability index to be 1.23, for example, it means for each 1 rand that we invested in a project, we got a return of 1 rand 23. So that's what the profitability index tells us. For each 1 rand we invested in a project, we got a return of 1 rand 23. So with the profitability index, we accept a project if the profitability index is greater than 1, and we reject a project if the profitability index is less than 1. To calculate the profitability index, we take our NPV and we add our initial investment and we divide by the initial investment. So it's NPV plus initial investment over initial investment, or we can just take the sum of the present value of all our cash inflows divided by the initial investment. Okay, so we can either simply add the NPV of our investment plus the initial investment divided by the initial investment, or we can take the sum of the present value of all our cash inflows divided by the initial investment. So basically what this means that the NPV plus the initial investment. The total of the NPV and the initial investment is just the sum of the present value of the cash inflows. So in this particular example we're looking at, we take our initial investment of 200,000, add our NPV of 313,104, and divide by the initial investment of 200,000, and then we get 2.57, which is greater than 1. So we accept the particular project. Then the next capital budgeting technique is the payback. The payback gives the number of years it takes for a project to return the initial investment. We accept a project if the payback is less than the target payback. So what will happen is that a company will have a target payback. For example, you might be told the target payback for a company is 3 years. And then what you do, you then calculate the actual payback of a project. You calculate the payback of a project. So we could calculate the payback of a project and get it to be 2 years. And then if the payback of a project is less than what the company is targeting, you accept the project. But if the payback of a project is, let's say 5 years, for example, meaning it's more than what the company is targeting, you reject the project. So the simplest way to calculate the payback is as follows. You take your initial investment, in this case, which is 200,000, and then you add the cash inflow for the first year, and then you see the balance that you have. So you see in this particular case, we spent 200,000 and then we're going to get 150 in the first year. So after the first year, we'll still have 50,000 that we have to collect. There'll still be 50,000 outstanding from the initial investment. Then you put the next cash inflow, which is the cash inflow for year 2, which is 100,000, right? And then you check to see whether the next cash inflow is greater than what's going out. Clearly, we can see the money that's coming in is more than what's going out here. So it means we can stop. It means we've come to the point at which all our money will be recovered. So the moment that you notice that the money coming in from a project is now more than the money going out, it means you stop there. Then you take the year just before your last negative cash flow, which is 1 year, and then you take the negative cash flow divided by the cash flow coming in the next year, which is 100,000, and then you get 1.5 years. Let me just illustrate this through another example. Let's say you spend 5 from a project. This is the initial investment. And then let's say after year 1, you're getting 2 from a project. If you say minus 5 plus 2, you're left with 3 to recover. And then let's say in year 2, you get 1 from a project. So if you say minus 3 plus 1, you're left with 2 to recover. And then let's say in year 3, you're getting 5 from a project. So now clearly we can see the money coming in is now more than the money going out, which wasn't the case here and which wasn't the case there. So we can stop. And then we take the years just before the last outflow. Then we take that last outflow divided by the last inflow. So it will be 2.4 years as our payback. So that's how we calculate the payback. And sometimes you can have uniform cash flows. If you have uniform cash flows, you just use the same approach. There is another approach of just dividing. Like let's say we had uniform cash flows where our initial investment was 200,000, which is the money going out. And then let's say every year for the next like maybe 5 years, let's say we have 200,000 going out today. And then let's say after year 1, we have 50,000 coming in. And then we have another 50 coming in. And then another 50. Let's say we have 50 coming in for 5 years, right? And then let's say we want to get the payback. If you have uniform cash flows, you don't have to create that table that I created, which is like this. You can just say the initial investment divided by the uniform cash flow. So in this case, it would be 200,000 divided by 50,000, and you would just get 4 years as your payback. You can still use the table, but it's not necessary. Okay, it's not necessary. You can just divide the cash outflow by the cash inflow. But the payback has a disadvantage in that it doesn't consider the time value of money. So rather what we can do, we can look at the discounted payback. We can look at the discounted payback. And the discounted payback gives the number of years it takes for a project to return the initial investment, factoring in the time value of money. So with the discounted payback, we use the same approach that we used here to calculate the payback. But the only difference is we first discount all the cash flows associated with the project. So we discount the 150, the 100, the 260, the 180. We find the present value of all those cash flows, which I'm sure you are able to do. Remember, you'll get your PVs as negative, but you can ignore those negatives. They don't mean anything in this context. So you would put your 150, N is 1, 12% interest, get your PV. So you get the present values, and then you just repeat that calculation for the payback. Initial investment plus year one inflow, get the balance, add the next inflow. The moment the next inflow is higher than the outflow, you stop there. You take the year before the last outflow divided by the last inflow, and we get 1.83 years. And again, we accept a project if the discounted payback is less than the target payback. So those were the capital budgeting techniques I was looking at through the example. Now I want to talk about the accounting rate of return, the modified internal rate of return, and the economic value added. These last three, they tend not to be asked in the exam, so we'll just talk about the accounting rate of return might be asked, but the economic value added and the modified internal rate of return, I doubt they would be asked. The ARR accounting rate of return, this gives the rate of return on a project using the accounting profit. So the accounting rate of return uses the profits that we get from the income statement of a company. We take the average net income divided by the average investment. And then the average investment, we calculate it by taking the initial investment in a project plus the residual value of the project divided by 2. This is usually the book value at the end, the estimated book value at the end, plus the initial investment divided by 2. So there's an example in the textbook that illustrates a calculation of the net income for 5 years for the company. You can see the net income after tax for this company after year one, it's 57,600. After year two, 165,600. Year three. So these are the net incomes. So we can average out those net incomes divided by 5 because it's 5 years, we get 144,000. We can assume that this particular project has 0 residual value. So we say 1,100,000. This should be plus. It shouldn't be minus. Yeah, I think it's a printing mistake. We say 1,100,000 plus 0 divided by 2, and we get 550,000. That gives us the average investment. And then we say that average investment, we say the average net income divided by the average investment, and we get 26.2%. So a company might have a target accounting rate of return, and they would accept a project if the target accounting, if the accounting rate of return we calculate is greater than the target accounting rate of return. We also have the modified internal rate of return. This, I doubt you would be asked to calculate this. It's just an extension of the internal rate of return, but the only difference is that it overcomes the weaknesses of the internal rate of return. The internal rate of return has a weakness and a disadvantage in that you sometimes get multiple internal rates of return when you have negative cash inflows in a project, and the internal rate of return has a wrong reinvestment assumption. The internal rate of return assumes that cash flows are reinvested at the internal rate of return, which is incorrect. The modified internal rate of return overcomes these two weaknesses. It prevents the possibility of multiple internal rates of return, and it also has a correct reinvestment assumption. It assumes that cash flows are reinvested at the cost of capital, which is correct, whereas the internal rate of return assumes that cash flows are reinvested at the internal rate of return. Lastly, we have the economic value added, EVA, economic value added. We've talked a lot about this, but I think at a high level, you can look at the formula to calculate the economic value added from your prescribed textbook or from the previous study units where we looked at it. They do talk about it here. But for this section of the textbook, you just have to know that we can also use the economic value added, which we calculate as the net operating profit after tax minus invested capital times WACC, right? So these two formulas can help us to calculate the economic value added, right? So we can discount the economic value added just like we do with the NPV, and we can accept a project if the EVA is positive, and we reject a project if the EVA is negative. So you would get the same result with the EVA as the NPV, but it's not something that would be likely to come up. And then lastly, I've just put some advantages and disadvantages of the different capital budgeting techniques. You can go through these advantages and disadvantages, and you can even read more around these. You need to make sure you know the advantages and disadvantages of the different capital budgeting techniques. Okay, so please read up on these. I've just written them in the notes, so you can go through the notes. And you can also read up on the different advantages and disadvantages of the different capital budgeting techniques if you read through part 1 and part 2 of chapter 8. Okay, the important thing to note is that the net present value, internal rate of return, and the discounted payback and profitability index, they use the time value of money. The payback doesn't, but the discounted payback does. So a lot of these will also be revision from your previous studies, and we'll see when we start doing exam questions whether or not they sometimes ask for the disadvantages and advantages of these techniques, but please make sure you know them. Okay, so that brings us to an end of this class on the module FIN4801. In the next class, we'll start looking at how to determine capital budgeting cash flows, which is very, very important for the exam. We'll spend some time looking at that. Any questions or queries on anything covered in the class, please feel free to let me know. I won't always be able to get back to you promptly, but I'll try to do so as soon as I can. Thank you once again for listening.